new job openings unexpectedly rising in May, topping economists' expectations. The new data is showing a resilient labor market ahead of Friday's full jobs report. Joining us now is Matthew Luzzetti, Deutsche Bank chief U.S. economist. Matt, it is good to see you. And let's get right to your take, Matt. I'm interested what you think is coming on Friday morning with that big jobs report. It was interesting, Matt. I don't know if you saw Nick Timrose, his latest column at the Journal. It was a good one. And the way sort of Nick kind of framed it was interesting. As a question, he sort of asked, is the labor market in this sustained equilibrium where the unemployment rate kind of settles out around 4%, or no, we keep softening, resulting in recession? I'm interested, Matt, how you think about that question.
Yeah, I think anytime you have kind of a slowing in the economy that's taking place, there's always a question about the trajectory. Are we slowing to something that's more worrying, a stalling out in the economy or perhaps even a recession? Or is it going from a very robust growth environment that we had last year back down to just something that's far more normal? I think it's definitely the latter. I think if you look at this morning's JOLTS data, you mentioned job openings were higher. Actually, the hiring rate had picked up. The quits rate has stabilized at somewhat low levels over the past 6 months. But all that together does suggest that after softening over the past 6 months or so, you're seeing a labor market that is stabilizing at this point in time. For Friday, we expect that you see jobs added about 225,000. The unemployment rate remains steady at 4%, but actually risk that could round down to 3.9%. Then you see average hourly earnings or wage growth firm again at 0.4%. And I think if we get that data point, it will alleviate some of the concerns around the idea that the labor market could be cooling too much.
My question to you is, as we have seen some of these softer econ prints here as of late, discounting the JOLTS report out this morning, but we have seen weakness in housing, manufacturing also coming in a bit weaker than expected earlier this week. What does that tell us just about your confidence here? Are you still confident that we are going to see a soft landing and be able to avoid a recession?
Yeah, it's still our baseline. You're right. You are seeing some slowing in the data. A lot of this was anticipated for quite some time. On the manufacturing side, the ISM manufacturing index was a little bit softer than expected. But actually, if you look at new orders relative to inventories, it's showing that we should have good growth momentum in the manufacturing sector. And that's actually a similar signal that we got from the PMI data this week as well. I think there's going to be a lot of focus on the consumer as we look ahead. Obviously, there's a lot of interplay between the consumer and the labor market. But if we continue to see a labor market that churns out meaningful income growth, something that we actually saw in the personal income report last week, it's really hard for me to see a reason why, with very high wealth, meaningful income growth for consumers, why the consumer should slow in a worrying way.
And Matt, when we talk about the consumer, of course, there's different consumers: high income, middle income, low income. Do you have a read on kind of how each is doing right now and what you see ahead?
Yeah, no doubt. I think you have a lot of heterogeneity in the consumer experience at this point in time. That is being driven in part by the drawdown in excess savings that we've had, particularly at the bottom half of the income distribution. You're seeing certainly some strains or stresses showing up there with higher delinquency rates. On the other side, if you look at the upper half of the income distribution, higher income households, they're benefiting from very high house prices, from equities that are near record levels. The fact that they're locked into low mortgage rates kind of insulates them from higher interest rates at this point in time. And the labor market is still chugging along here, despite the slowing that we've seen. So there is definitely some divergences in the data that we're seeing. I think importantly, though, from an aggregate or macro perspective, which is what the Fed will be most focused on, at the moment, it looks like a consumer that's slowing just to more comfortable levels rather than something that is either stalling out or recessionary at this point.
So then, Matt, given that, and also just the commentary from Fed Chair Jay Powell earlier today, I'm curious just to get your perspective on what this tells us about that first rate cut, because he didn't explicitly say or give us any hints on the timing. But when you take into account what he is saying, or what he did say, the fact that the labor market is cooling, the fact that he is very much encouraged by some of the progress that we have seen on inflation, what does that then tell us, just do you think, about the odds of a cut in September?
Yeah, our baseline is that you get one cut this year and then it happens in December. But there are certainly some prospects for a September rate cut. That can come in one of two ways: that we get better inflation data over the next several months. And as that clip showed, Chair Powell has been encouraged by at least the last inflation print. Certainly if we get something that looks like last Friday's core PCE print over the next several months, the Fed could very well cut at the September meeting. The other way to get to a rate cut is that you have a weakening in the labor market that's unexpected. That's the area where, that is a downside risk, but it is not part of our baseline at the moment. From Chair Powell's comments this morning, I did sense a little bit of a dovish tone to that. He was encouraged by the inflation data. He's certainly looking at a labor market that is coming into much better balance and is not an important source of inflation at this point in time. And so really they'll be data dependent. Essentially if they get very good inflation data over the next few months, that will certainly improve the prospects for a September rate cut.
Matt, election is front and center. That means tariffs are front and center as well. Biden and Trump have both embraced that. I'm just interested as an economist how you think, Matt, about that policy tool. Do you think it's smart? Do you think it's effective? What's the potential impact on the economy, Matt?
Yeah, I think from an impact on the economy perspective, it really matters kind of the breadth and size of those tariffs. Certainly we've seen President Biden embrace that to a certain extent, but it's been quite narrow on things like imports of electric vehicles from China. The proposed tariffs from the potential Trump administration are much broader. They're much higher. He's thinking and contemplating a 10% universal baseline tariff. That's a 10% tariff across the board, contemplating 50 to 60% tariffs on imports from China. That would have a meaningful macro impact. And so, as we think about the Federal Reserve in particular over the next year, December and then into next year, the election outcome will be important for how much they cut rates. And if we get an election outcome that promises fiscal stimulus via tax cuts and inflationary policies through tariffs, it'll be less likely that the Fed cuts rates meaningfully next year.
Matt, great to have you on today. Thanks for helping us kick off the show. Appreciate it.
Thanks for having me.